Hello everybody, welcome to the first e-news of 2024. Thank you for joining us. So we're getting a little bit of a stock market sell-off to start the year, which is absolutely to be expected when you look at the huge run-up we saw in the stock market at the end of 2023. So market participants in 2024 are expecting the Federal Reserve to cut interest rates 6 times. Josh and I think that is overly optimistic, especially when you look at the situation in the U.S. economy. Unemployment is 3.7%, so the lowest in 50-something years. Inflation is still higher than the Federal Reserve would like it by about 75%. So inflation, their target is 2%, and we're north of 3.8, depending on what data you look at. So inflation is a lot higher than the Fed would like, and it's hard for us to imagine that interest rates right here are restrictive. Now, if you're in the mortgage business, of course, that it's restrictive for you. But when you look at the economic activity, if you go to an airport in the United States, they're all full, airplanes are full, and so economic activity in the U.S. is still really quite robust. And so it's hard for us to imagine in this environment that we're seeing right now, the Fed is going to cut rates. And so if that's true, if the Fed holds steady with interest rates, the stock market is going to be dependent on earnings growth on a go-forward basis. And so there's some other factors that are going to be a big driver in the U.S. economy, and that's always the interest rate environment and what happens with interest rates.
Speaking of robust economic activity, today we got December's retail sales data. Came in significantly better than expectations. No surprise there for everyone that is out there participating in Main Street, but what that's led to is higher bond yields, which in turn are leading to a lower stock market. And so remember, at the end of the year, much of the stock market's increase came from multiple expansion, meaning investors were willing to pay more for the same dollar of earnings. Now we need to see earnings sort of catch up to stock valuations. Earnings are coming in better than expected so far. We're only really just in the first few days of earnings season, but it's going to probably take a couple quarters of good earnings for market valuations to really support what's happened in the market itself. So we're pretty optimistic, I think, for 2024. But at the end of the day, you're going to need to see higher earnings. And I think a big portion of that in 2024 is also going to come from corporations fine-tuning, starting to see significant layoffs, not affecting the overall unemployment number, but corporations are driving higher profit margins by reducing headcount. We're returning to a lot of the dynamics that existed before the pandemic ultimately. And without absent interest rate cuts, markets are only going to go higher on the back of better earnings.
So the other thing is, remember, 2024 is an election year. Historically, election years have been good for the stock market. So like Josh said, we're optimistic about 2024, but that doesn't mean we're going to not have a ton of volatility. I mean, if you go back and you remember 2023, we had the banking crisis in the spring, then stocks rallied again, and in the fall, markets sold off. So we had a ton of volatility in 2023 in the stock market, yet stocks had a banner year. So I don't know that we're going to have quite as good a year as last year, but Josh and I are relatively optimistic about the potential for stocks in 2024. So as always, if you have questions about your situation, you can call us at the office, 800-743-0988, and we'll see you back here in 2 weeks.